Let's talk about taxes. When a politician says, "I'm going to cut your taxes," it sounds fantastic. They tell us if we let the wealthiest people and corporations keep more money, it will flow down to the rest of us. We're told this will create jobs, boost the economy, and make everyone better off. This idea is trickle-down economics. The idea is that if you pour money into the top, it will trickle down. However, if you're still waiting for that trickle, you're not alone. For decades, this promise has been the centerpiece of economic debates. It feels like we were promised a feast, but all we got was the leftover crumbs. It's time to ask if this promise is just a story to keep us from asking for a fair share. So here is the big shiny billion-dollar question that we need to unpack. Do tax cuts for the rich actually work as advertised? Is this trickle-down theory a brilliant economic strategy that benefits everyone? Or is it one of the biggest and most successful scams of the modern era? This isn't just a fun little thought experiment for economics professors to debate over stale coffee. The answer to this question affects literally everything. It determines how good our schools are, how safe our bridges are, and whether you can afford to see a doctor when you get sick. This is about real money, real people, and real consequences. To figure this out, we need to do something that might sound scary. Look at the evidence. Don't worry, we'll make it simple. We won't be using complicated charts that look like a heart attack on paper. Instead, we'll look at what actually happens when these tax cuts are put into practice. We'll follow the money. When a corporation gets a huge tax break, where does that cash go? Does it go into new jobs and higher wages for its employees? Or does it go somewhere else entirely, like into the pockets of shareholders, or the CEO's bonus, which they then use to buy another yacht, a yacht they might name Trickle Down? We're going to bust some of the most popular myths you hear every day. You know the ones. Tax cuts for the rich pay for themselves. The wealthy will just leave the country if we tax them more. Cutting taxes is the only way to stimulate the economy. These are repeated so often that they start to sound like undeniable facts. But are they? Or are they just clever talking points designed to convince the public to support policies that overwhelmingly benefit a tiny, incredibly wealthy minority? We're going to put these myths under a microscope and see if they hold up to any real scrutiny at all. This isn't about class warfare or being jealous of rich people's fancy toys. This is about basic fairness and building a society that works for everyone, not just for the people who can afford to hire an army of lobbyists. It's about understanding the rules of the game and asking if those rules have been rigged. So, get ready. We are about to take a deep dive into the shocking, sometimes infuriating, and often downright bizarre world of tax cuts for the rich. By the end, you'll be able to see past the promises and understand the truth about who really wins when taxes get slashed. It's a story you can't afford to ignore. To understand the tax cut obsession, let's travel back a few decades. In the post-war era, the US had relatively high taxes on the wealthy. The economy did pretty well, the middle class grew, and infrastructure was built. But in the late 70s, stagflation created an opening for a new idea. Arthur Laffer argued that high tax rates disincentivize work and investment. Lower rates, he claimed, would boost the economy and increase tax revenues. This appealed to wealthy individuals and corporations. They and conservative politicians began a PR campaign to sell supply-side economics. It was framed as a way to unleash American entrepreneurs by freeing them from regulation and taxation. The answer was just one thing: cut taxes, specifically on those at the top. What's good for billionaires is good for everyone. This was the birth of the trickle-down promise. The leading man for this new economic blockbuster was Ronald Reagan. When he became president in 1981, he was the great communicator. Reagan made supply-side economics the centerpiece of his administration, known as Reaganomics. He told Americans that the government was the problem and massive tax cuts would unleash the free market. In 1981, Reagan signed one of the largest tax cuts in American history into law. The logic was trickle-down. Letting job creators keep more profits would lead to reinvestment, hiring, and widespread prosperity. The economy did recover, and the stock market boomed, but the benefits were not evenly distributed. Wages for the typical worker barely budged. Tax revenues went down, and the national debt skyrocketed, nearly tripling during Reagan's time in office. The government had to make deep cuts to social programs. The experiment resulted in a massive transfer of wealth upwards and a ballooning national debt. After the Reagan experiment, the obsession with tax cuts for the rich didn't fade. The core idea became entrenched in American politics, a default setting for both Republicans and Democrats. The myth had taken hold. Politicians talked about being pro-business, which translated to lower taxes for corporations and the wealthy. Presidents Clinton, Bush, Obama, and Trump all signed tax cuts. The tax cut for the rich playbook is always on the table. Lobbying, think tanks, and campaign donations ensure laws favor the wealthy. The idea that low taxes for the rich are essential for economic growth is repeated so often it's accepted as fact. It has normalized measuring economic success by the Dow, not the well-being of the average family. It has cemented the trickle-down myth as common sense. This is a decades-long sales campaign to adopt a policy that has repeatedly failed. Let's tackle the biggest myth, the job creator. We're told that billionaires and big corporations are the engines of job growth, and if we tax them, they'll take their jobs elsewhere. So we're supposed to give them tax cuts, hoping they'll reward us with jobs. But here's the truth. Businesses hire when there's demand, not because CEOs have extra cash. A coffee shop owner hires a new barista when the line is out the door, not because of a tax break. The real job creators? Ordinary people spending money. When regular folks have more to spend, businesses grow and hire. Giving tax breaks to the rich doesn't create jobs if there's no demand. It's like giving a chef fancy ingredients when the restaurant is empty. Nothing gets cooked. The job creator myth flips reality. It's customers, not billionaires, who drive job growth. Prosperity comes from a broad, thriving middle class, not from appeasing the ultra-wealthy. The idea that we must keep the rich happy for jobs is a hostage situation, not economic wisdom. This story falls apart the moment you look at how the economy really works. So, where do those tax cuts for corporations actually go? Instead of hiring or raising wages, companies overwhelmingly choose stock buybacks. A stock buyback is when a company uses its cash to buy its own shares, making the remaining shares more valuable. This mainly benefits wealthy investors and top executives, not workers. After the 2017 corporate tax cut, companies spent over $1 trillion on buybacks, a record. That money didn't go to new jobs or higher pay, it went straight to shareholders. This isn't a secret, companies announce buybacks proudly. The job creator promise becomes a joke when tax cuts just enrich the already wealthy. It's a government-approved transfer of wealth from the public to investors. Imagine a firefighter using the water hose to wash his car while the house burns. That's how tax cuts are used. The tools meant to help everyone are hijacked for personal gain. The real winners? The investor class, not the workers. The evidence is right out in the open. Next up, a rising tide lifts all boats. The metaphor suggests that economic growth helps everyone, rich or poor. But in reality, we're not all in the same boat. The wealthy have super yachts, most people are in leaky rafts. When the economy grows, the rich soar while many struggle to stay afloat. Over the last 40 years, national wealth has exploded, but inequality has too. The rich have seen their fortunes skyrocket, while most people's incomes have barely moved. The rising tide has lifted yachts, not rafts. Growth alone doesn't guarantee shared prosperity. The promise that everyone benefits equally is a myth. The gap between rich and poor keeps widening despite economic booms. The tide is rising, but only the yachts are floating higher. Let's talk about wages, the real impact of these myths. We're told that when corporations do well, workers do too. But since the 1980s, worker productivity has soared while wages have barely budged. All that extra value created by workers, it went to profits and executive pay, not to the people doing the work. The link between productivity and pay was broken. CEO pay exploded from 20 times the average worker's wage in the 1960s to 400 times today. This isn't an accident, it's the result of policies that favor the top. Tax cuts and stock buybacks boost executive compensation, not worker pay. We were promised that tax cuts would raise wages for everyone. The opposite happened. The money flowed upward, not outward. When politicians promise more tax cuts to boost wages, remember we've tried that for 40 years. The result? Stagnant wages for most, massive gains for a few. The system is designed to reward wealth at the top, not prosperity for all. The super wealthy make money differently than most people. They make the bulk of their money from investments like stocks, bonds, real estate, and entire companies. When they sell these assets for a profit, it's called a capital gain. Capital gains are taxed at a much lower rate than wages. This lower tax rate is a golden ticket for the ultra-rich, allowing their wealth to grow rapidly. There's also a loophole called the stepped-up basis, where inherited assets are revalued at their current market price, potentially eliminating capital gains taxes altogether. This combination creates a system where fortunes can be passed down with minimal taxation. It's why some billionaires pay a lower effective tax rate than their secretaries. It's a tax code engineered to favor wealth over work. Now let's talk about the corporations. The big promise of the 2017 tax cut was that slashing the corporate rate from 35% to 21% would make America more competitive and bring jobs back home. But here's the thing. Even before that cut, many of the biggest and most profitable corporations in the country were already paying nowhere near 35%. In fact, many were paying nothing at all. They achieved this through a dizzying array of loopholes, deductions, and accounting tricks that would make a magician blush. It's a sophisticated shell game designed to make billions of dollars in profits look like they magically disappeared right before the tax bill came due. One of the most popular tricks is using offshore tax havens. A giant American tech company sells its products all over the world, but arranges its corporate structure so that the profits don't officially show up in the United States. Instead, the profits are routed through a subsidiary in a country with a near-zero tax rate. The scale of this is staggering. Before the 2017 tax law, it was estimated that United States corporations were holding over $2.6 trillion in profits offshore to avoid paying United States taxes. A 2021 report found that at least 55 of the largest corporations in America paid $0 in federal corporate income taxes in 2020 on billions of dollars in profits. They weren't breaking the law, they were just using the law as it was written for them. The real rate that companies pay is much lower thanks to this army of lawyers and accountants exploiting every loophole they can find. Let's zoom in on the last 30 years to see how different presidents have shaped the tax landscape and who benefited most. First, the Clinton years. In 1993, President Bill Clinton raised the top federal income tax rate on the wealthiest Americans from 31% to 39.6%. He also increased the corporate tax rate slightly. The idea? Balance the budget and invest in the middle class. By the end of the decade, the economy was booming, and the deficit had turned into a surplus. Fast forward to the early 2000s, President George W. Bush slashed the top income tax rate from 39.6% down to 35%. Corporate taxes stayed mostly the same, but the biggest changes were for the wealthiest households. The Bush tax cuts were sold as a way to spur growth, but they also ballooned the deficit and sent more wealth upward. Next was President Obama, who took office during the Great Recession. For most of his presidency, the Bush-era tax cuts stayed in place, but in 2013, Obama restored the top income tax rate to 39.6% for the highest earners. Corporate tax rates didn't change much, but new taxes on investment income for the wealthy were introduced to help pay for healthcare reform. Then came President Trump's 2017 tax overhaul. The top individual tax rate dropped to 37%, but the biggest change was for corporations. The corporate tax rate fell from 35% to just 21%, the lowest in modern U.S. history. Trump's tax law also cut taxes on large estates and gave special breaks to owners of pass-through businesses. The result? A windfall for the wealthy and big companies, while the deficit soared. Finally, President Biden. In his first years, Biden has pushed to raise the corporate tax rate and the top personal rate, but so far, the Trump-era cuts remain largely intact. Some proposals would increase taxes on the ultra-wealthy and large corporations, but Congress remains divided. Through all these shifts, one pattern stands out: when taxes on the rich and corporations go down, inequality goes up. Charts and tax tables tell the story, different faces in the Oval Office, but the same debate: who pays and who benefits? When the government gives massive tax cuts to corporations and the ultra-wealthy, it loses revenue, trillions of dollars. This creates a giant hole in the national budget. When the government has a hole in its budget, it cuts back on essential services. This is the hidden price tag of trickle-down economics. Good public schools, well-maintained roads, and clean drinking water aren't free. They are paid for with tax dollars. So when those tax dollars are given away as tax cuts for the rich, there's less money available for everything else. The cuts come for things like education funding and infrastructure projects. It's a slow erosion of the public good. These are the consequences of defunding public services to finance tax cuts for the wealthy, creating a vicious cycle. We pay the price in the form of crumbling infrastructure and a lower quality of life. The impact of tax cuts seeps into the very soul of our society, changing how we interact. The massive gap between the ultra-rich and everyone else creates a two-tiered society. This has a corrosive effect on social trust and our sense of shared community. Extreme inequality impacts public health. Studies show societies with higher inequality have worse health outcomes for everyone, including higher rates of chronic illness, lower life expectancy, and more mental health issues. Furthermore, this inequality distorts our democracy. When vast wealth is concentrated, political power follows. The ultra-wealthy can fund campaigns and hire lobbyists to shape public opinion, serving their interests. We are losing the sense of a shared destiny. The American dream was about economic mobility, but when the system is rigged, that dream feels like a fantasy. The social fabric, phrase. Tax cuts for the rich are making our society poorer, sicker, and more divided. The evidence is clear. Trickle-down economics is a failure. Tax cuts for the rich primarily benefit the rich and increase inequality. So why does this idea refuse to die? It's not because politicians are stupid, it's because a powerful, well-funded machine keeps these myths alive. This machine has three components: political money, think tanks, and a compliant media ecosystem. Wealthy individuals have a direct financial interest in low taxes, making it their best investment. Think tanks build the intellectual architecture of the myth, producing studies arguing for lower taxes. The media often presents a he said, she said conflict, failing to convey the evidence against trickle-down. This machine ensures that no matter how many times trickle-down fails, it's always ready for a comeback. So where does that leave us? We've busted the myths that tax cuts for the rich create jobs or lift all boats. The money overwhelmingly flows into the bank accounts of the already wealthy. We see a society dangerously divided by historic levels of inequality. The experiment has failed. So, what would a fairer system look like? First, we could tax wealth the same way we tax work. Second, we need to properly fund the IRS. Finally, we could demand that corporations pay their fair share. It's an investment in our collective future. And we can and should choose to build something better. If you enjoyed this video, please subscribe to our channel, like, and leave a comment below. It really helps us out.